We're going to move on here now into step 3 of the presentation, and that's going to be how to understand the required minimum distributions. So the government eventually wants you to pay tax on the money that you've built up in these pre-tax tax deferred plans like IRAs, 401ks, 403bs. When you have to start drawing the money out depends on your age 70 and a half or age 72. Now, to clarify how this works, if you're born, if you turn 70 and a half prior to December 31st of 2019, you're going to be under the old rules. If you had not turned that age by then under the new Secure Act, you can start your RMDs at age 72. So how much do you need to take out every year? Well, you take a look at your prior year's ending account balance, and the IRS gives you this nifty chart that gives you a distribution period or a life expectancy. So if you're age 70, the distribution period is 27.4 years. Another way of looking at it is if you take 100 divided by 27.4, that would give you a percentage of 3.65%. So all in all, it's not a huge amount that you have to take out early on out of your retirement plan. It's just basically some of the interest or some of the growth. The older you get, the more you're going to have to take out. So when you're 90 years old, the distribution is going to be about 8% of your account balance. Now, question is, or here's another example of $500,000 IRA balance at age 70. So 500,000 divided by 27.4 equals $18,248 a year. So if you have $1 million in your retirement plan, it would be $36,000. If you have $100,000 in your retirement plan, it's going to be $3,650. So it just depends upon how much you've built up in these plans and how much impact it's going to have on your tax return at these ages. What happens if you don't take the required minimum distribution? Well, it's a very nasty tax penalty. The tax penalty is actually 50%. So it's 50% tax penalty plus the tax on the distribution plus the interest on the penalty. So be really careful not to miss your minimum distributions. And where we see this costly mistake happening is especially for people that have multiple accounts. Let me give you an example. So I have one of my longtime clients. His name is Mark, and Mark is age 60, and so he doesn't have to do required minimum distributions, but he's actually helping his mother, Mary, who is age 82. She's in the category that she has to do her distributions. Now, Mary actually has 7 accounts that she's doing distribution from. She has a 403b account where she used to work at a nonprofit. Her deceased husband, Mark's dad, actually had 2 401k accounts from corporations he used to work at. And in addition to that, Mary and her deceased husband each had 2 IRA accounts for a total of 4 IRA accounts. One was at a brokerage, one was at a bank. But anyway, 7 different accounts that she needs to do RMDs on. Now, if you can picture this, Mary has investment statements coming in every month from those 7 accounts. There's mutual fund statements, there's proxy statements, there's performance statements, and once a year in a nondescript envelope, she receives from the IRA company a question saying, hey, Mary, are you going to do a distribution from us or are you going to take care of it on your own? And if she doesn't respond and ask for the distribution, then it's a negative response letter, and so the IRA company is going to do nothing. So odds are pretty high eventually Mary's going to miss one of those distributions, have a huge tax penalty. And so what I recommended to Mark is I said, Mark, take those multiple accounts and put them into a self-directed IRA account, put them into one account. You can still own all your different investments that you enjoy having, the mutual funds, the ETFs, and so forth. Once they're in this account, it's going to be much easier for you to see and have online access on it so you can keep an eye on it in the event of senior fraud. You can make sure your mother is automating her required minimum distributions. And eventually, Mark, I'd recommend that you have like power of attorney and become her personal contact on these investments. Mom was all for that. Actually, his mother, unfortunately, is going through dementia and has been, admitted into a long-term care facility, which I'll talk a little bit about later on how to protect those assets. But now, another thing that I'll say is that if Mary had 7 accounts and Mark has 2 sisters, you can imagine how many distributions that would be at Mary's passing. So that would be 21 distributions, because each of the 3 kids are splitting the 7 accounts. It becomes very complicated. If it's in one IRA account, well, it's only 3 different distributions. So what are the rules of inheriting an IRA? If it's a spouse that you're passing the money on to, then they get to keep it tax deferred and just do minimum distributions based on their life expectancy. If a child inherits the money, then they'll need to take that money out over a 10-year period under our new Secure Act tax laws. So you can't keep that money deferred forever. That's for IRAs, 401ks, Roth IRAs. And I wanted to mention that for those individuals that may have listed a trust as the beneficiary on their retirement account, you'll probably want to revisit that with whoever helped you set up that trust, or if you need help revisiting it, we do reviews of estate plans, because oftentimes that money will go into the trust, but now under the new regulations, it has to be distributed out over a 10-year period, and that might not have been what your original intent was. I want to bring up also this thing called the QCD. It's a qualified charitable distribution. So this is super important. If you're planning to gift money to charity, you can actually gift directly from the retirement account, and there's no tax to you and no tax to the charity. How this comes in handy is, let me give you an example. I have a client, his name is Rod. He's gifting about $5,000 a year to nonprofits, but Rod's standard deduction is higher than his itemized deduction. So he's not able to take a tax deduction for his charitable giving. So instead, what he's doing is he's having the IRA distribution go directly to the nonprofit, and therefore there's no tax to him and no tax to the charity. So QCD is a very powerful way of getting money onto charities. These are the new Secure Act regulations. So I've already talked about how some of those things have changed up.